Hi everyone, and thank you for returning to Everything Tesla Stock. Over the years, a number of stock analysts and Tesla bulls have made forecasts about Tesla stock. And now there's another one. This time though, it's really big news. It turns out that Tesla stock may be worth much more than the current $3,369 a share, an extraordinary finding. A multimillion-dollar investment firm that used a 30-year discounted cash flow model for Tesla disclosed this in a report. But why did they award such an absurd evaluation? Yes, we have witnessed Tesla's incredible rise in the past, but is it capable of doing so once more? When? Let's see how this all adds up then. It's really bizarre. Tesla's stock has been performing well lately, but it is still trending upward, and the $3,369 stock price may be worth paying attention to. Let's investigate. Before we get started, please click the like button, subscribe, and enable notifications if you enjoy this kind of content so you can stay informed about everything Tesla releases. A well-known innovator and investor, Holland is a multinational stocks management company. The Sydney-based company estimates that the current value of Tesla shares, which are at $673, is 5 times higher than their true value. This comes after a full year of investigation that culminated in a 144-page analysis on Tesla that was released by Tim Davies, the research director at Holland, and Hugh Bank, the company's managing director and portfolio manager. The stock price was anticipated in the study to be $3,369 per share. However, why was it the case? According to Holland's report, Tesla will produce a staggering 51 million units by 2030, 136 million units by 2040, and 184 million units by 2050. Though it will obviously take a lot of work to get these values down to the minimum, the two of them think there may be a workaround. The estimated stock price, according to the report, is predicated on the expectation of an increase in demand for electric vehicles in the future, which can be predicted by two main factors. The first is the potential government ban on internal combustion engine vehicles in an effort to reduce carbon emissions from transportation, and the second is the potential increase in development rates in nations like China and India, which could raise income levels and, in turn, the rate at which cars are owned. Let's go numbers. According to Holland, this prohibition may result in 1.97 billion more electric cars on the road by 2040. This is 24% more than the International Energy Agency's estimated value of 1.6 billion. Similarly, by 2050, 40% of Chinese and Indians will own a car, respectively. This could raise awareness of small electric cars like Tesla's upcoming Model 2. For Tesla, this might be quite significant. Based on these projections, is it possible to argue that investors aren't paying enough attention to Tesla's core business? All oak, maybe. Tesla is a growing star, and its future prospects should be used to evaluate the company rather than its 2022 earnings. According to Holland's forecasts, there may be a future increase in demand for automobiles, which would significantly increase Tesla's pace of production and have an impact on the company's stock price. Additionally, the price may be higher than anticipated in the positives, bringing in a sizable profit for Tesla's stockholders. Thus, it's possible that investors should reconsider their decision to sell off their Tesla stock. Also, Tesla has a lot of opportunities for long-term growth and is well positioned to lead the EV sector in the years to come. The prediction is comprehensive, even though there may be disagreements about Tesla fulfilling its manufacturing targets this year and in the years to ahead. Without a doubt, Tesla has the capacity to surpass expectations. The automaker will undoubtedly have a difficult challenge ahead of it, and its stock price may fluctuate, but long-term investors shouldn't be excessively concerned about such things. Long-term, it appears like Tesla is working on a number of projects, and Elon Musk has shared several of these plans, which have the potential to dominate the EV market. Elon Musk has stated that Optimus, a humanoid robot, will be worth more than the automobile industry. Tesla has also made significant progress toward fully autonomous vehicles with its robotaxi, which will cost less to travel than a bus ticket. The question now would be, are these projects truly attainable? The projects have a high probability of success because the market is profitable for Tesla's ambitious growth programs. It is highly probable that Tesla will invest in a project that the market values highly and can enable it raise money at a low cost. According to Holland's analysis, Tesla's whole manufacturing process makes use of robots and artificial intelligence, which enables it to achieve industry-leading profit margins that are significantly higher than those of its competitors that make internal combustion engine vehicles. Tesla also manages its own sales channels, which give the business significantly larger profit margins than conventional automakers that depend on dealer-distributed networks. Nonetheless, there's no denying that Tesla can increase sales with the right policies in place. If Tesla employs a modular manufacturing approach to expand the production capacity of both its current and upcoming facilities, it may significantly boost output while lowering operating expenses. The problem here, though, and the main danger to Holland's projections, is that there may not be an adequate supply of raw materials to meet the demand for lithium-ion batteries. It will take a 298% increase in lithium supply for Tesla to reach its manufacturing targets through 2030. Furthermore, Tesla will need to put in a lot of work to produce enough electric cars to meet global demand. Following the Russia-Ukraine crisis, the auto sector is presently dealing with production constraints, and Tesla is not exempt from these difficulties. Investors are a little concerned about this because missing these goals could have an impact on the price and valuation of the company. Their concerns were further heightened by Tesla's decision to close its San Mateo, California office and eliminate positions for autopilot personnel. As a result, numerous analysts lowered their predictions for the company. But given Tesla's rising reputation, this shouldn't be a cause for concern. Tesla may easily turn the projected rise in demand for electric vehicles into a huge cash gain if it can effectively overcome its raw material hurdles. According to Holland, Tesla's yearly free cash flow should reach roughly $500 billion by 2037 and $1 trillion by 2047, enabling the company to begin share buybacks and dividend payments in 2025. If everything proceeds according to plan, Tesla may amass long-term investment holdings worth $20 trillion by the year 2050. It went on to say that Tesla might make $2 trillion in revenue from EV software and energy production before increasing to $3 trillion in 2039 and 2047, respectively. For Tesla, there is a lot in store, but it's not a good idea to get overly enthused about Tesla's more speculative growth prospects. On the other hand, it might be a mistake to have low expectations for Tesla. Long-term valuation is determined by factors other than the current constraints, and there is a strong possibility that Tesla is worth the $3,369 asking price. With goals for the near and long terms, Tesla is well positioned to lead the electric vehicle market and may soon surpass its competitors in size. According to Holland, during the course of the next 5 years, additional gigafactories will be opening in China, India, and Southern Europe, with Tesla's 2 planned gigafactories in Nevada and Berlin scheduled to begin production shortly and the potential to expand manufacturing capacity to 5.5 million cars annually by 2025. This might be worth the hype. Tesla can reach a lot of Holland's projections for a variety of reasons. The EV business has an advantage over most of its rivals because of its reputation in autonomous driving software. 2025 is also when its FSD Level 4 autonomous system is anticipated to arrive, which will be another significant accomplishment for Tesla. Going one step further, Tesla owners can save money in the long run with their innovative integrated energy solutions, which combine solar power, battery storage, and electric cars into a single offering. Due to their present $250 billion debt, the majority of Tesla's rivals, including GM and Ford, will find it difficult to keep up with this. Utilizing this advantage, the EV manufacturer gathers a vast amount of data necessary for the development and testing of an efficient autonomous system. As a result, Tesla has produced a number of impressive products. Although Bank, Holland's managing director, noted that this pattern in automobile purchases is likely to change in the upcoming years, and that if it does, Tesla's pricing may see a significant increase, Holland believes Tesla will continue to lead the EV market for years to come. Having said that, the primary disadvantage of a stock is typically its current condition, which suggests that investors may be more concerned with that than the underlying fundamentals of the company. Needless to say, Tesla is not an inexpensive company. At present, its market value is 44 times the free cash flow projections made by Wall Street experts for the year 2024. Accordingly, based on Holland's prior estimations, there might be more to Tesla stocks than meets the eye. Based on past results, Tesla is probably going